Tax rates and tax disclosures are important aspects of financial statement analysis because they help analysts evaluate a company's profitability, cash flow obligations, and tax management strategies. The program explains that companies report both current tax expense and deferred tax expense, which together form total income tax expense on the income statement. Effective analysis requires understanding the relationship between statutory tax rates established by governments and effective tax rates reported by companies. Tax disclosures provide additional information regarding temporary differences, deferred tax balances, valuation allowances, and tax planning strategies. Analysts use this information to assess earnings quality, sustainability of profits, and future tax obligations that may influence long-term financial performance and shareholder value. The statutory tax rate is the official rate imposed by tax authorities on taxable income within a particular jurisdiction. However, a company's effective tax rate often differs from the statutory rate because of permanent differences, temporary differences, tax credits, international operations, and various tax planning strategies. The effective tax rate is calculated by dividing total tax expense by pre-tax accounting income. Analysts compare effective tax rates with statutory rates to evaluate whether a company benefits from favorable tax structures or faces unusual tax burdens. Significant deviations may reflect operations in low-tax jurisdictions, tax incentives, non-deductible expenses, or aggressive tax planning practices that could affect future profitability and financial sustainability. Tax disclosures provide detailed explanations of the factors causing differences between statutory and effective tax rates. Companies typically present a tax reconciliation that identifies the impact of permanent differences, foreign tax rates, tax credits, valuation allowances, and other adjustments affecting total tax expense. Analysts review these disclosures carefully because they improve transparency and help identify recurring versus non-recurring tax effects. Large or unusual reconciliation items may indicate one-time tax benefits, restructuring activities, or changes in tax law that temporarily influence reported profitability. Understanding these disclosures allows analysts to forecast future tax expense more accurately and assess whether current effective tax rates are sustainable over the long term. Deferred tax disclosures are another important component of tax analysis. Companies disclose the nature and amount of deferred tax assets and deferred tax liabilities arising from temporary differences between accounting profit and taxable income. Analysts examine these disclosures to evaluate future tax consequences and assess the likelihood that deferred tax assets will be realized. Valuation allowances against deferred tax assets are especially important because they indicate management's assessment regarding future taxable income. Significant increases in valuation allowances may signal declining profitability expectations or reduced confidence in future earnings potential. Analysts therefore integrate deferred tax analysis with broader evaluations of operational performance, cash flow generation, and long-term business sustainability. International operations further complicate tax analysis because multinational companies often operate across multiple tax jurisdictions with varying statutory rates and regulations. Differences in tax systems, transfer pricing policies, withholding taxes, and repatriation rules can significantly affect reported tax expense and effective tax rates. Analysts review geographic disclosures and foreign tax information carefully to understand how global operations influence tax obligations and profitability. Changes in international tax regulations or tax enforcement policies may also create uncertainty regarding future tax expense. Companies with unusually low effective tax rates due to aggressive international tax structures may face regulatory scrutiny, reputational risks, or future increases in tax obligations affecting long-term shareholder value. A thorough understanding of tax rates and disclosures is essential for evaluating earnings quality, forecasting future profitability, and assessing financial risk. Tax accounting involves substantial management judgment regarding future taxable income, deferred tax asset realization, and interpretation of evolving tax laws. Analysts use tax disclosures to distinguish sustainable operating performance from temporary tax-related effects that may distort reported earnings. Transparent tax reporting improves investor confidence and supports more accurate valuation analysis. By carefully evaluating effective tax rates, deferred tax balances, and disclosure information, analysts gain deeper insight into a company's financial health, operational strategy, and long-term ability to generate value within increasingly complex global tax environments.